Ladies and gentlemen, good day, and welcome to the Kraft Limited Q4 FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectation of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rajendra Gandhi, Managing Director. Thank you, and over to you, sir.
Thank you. Good evening, everyone. I hope that all of you and your families are safe and healthy. On behalf of Kraft Limited, I extend a very warm welcome to all participants on the Q4 and FY23 financial results discussion call. Today on the call, I am joined by Mr. Balaji A.S., our CFO, and the Orient Capital, who are our investor relations advisors. We have uploaded our investor deck and earnings press release on the stock exchanges and the company's website. I hope everyone had an opportunity to go through them. During the year FY23, the industry witnessed weak demand scenario across markets, and despite the challenging business environment, the company has emerged with a significant volume and value growth in revenue by 13% in FY23. To INR 1,284 crores and EBITDA growth of 4.4%. All product categories grew in volume, ranging from 8 to 16%, aided by our strong brand identity, robust distribution channels, and effective marketing strategies, and a strong manufacturing facility. The company continues to strive hard to gain market share across business verticals and distribution channels. In FY23, we delivered a robust growth across product categories on year-on-year basis. Our pressure cooker category reported a growth of 19.6%. Non-stick cookware registered a growth of 16.8%. Induction cooktop grew by 13.4%. Small appliances grew by 11.1%. And gas cooktop marked a growth of 4.3% during the year. This growth across various categories is testament to our robust and resilient business model and our ability to steer onto the growth journey in the most challenging periods. Our aspiration of driving growth in a sustained and responsible manner while being future ready to capitalize on the upcoming market opportunities form the bedrock of our success. We communicated in our last earnings call with reference to the implementation of a new organization structure. It gives me immense pleasure to announce we have successfully completed the hiring for all new positions, and the team has already started working towards achieving the organization goal. During the 2 years, we have also decided to strengthen our composition of the board of directors. And in this direction, we have now 2 new independent directors on the board, Mr. Avinash Gupta and Mr. Natarajan Ramakrishna, for effectively advocating the interests of stakeholders through their vast years of experience in professional career previously. Our growth momentum continues in addition of company-owned and company-operated retail stores for the Pigeon brand. During the year FY3, we have successfully added 54 stores in southern markets. We remain committed to accelerate our store reach in FY24 with a target to open 7 to 8 stores every month. The company is in final stages of formulating a business model to expand retail stores also through franchises. This model would help us reduce the initial cash outlay and recurring fixed costs substantially. Given the challenging business outlook, we have taken a call to stagger some of the planned capex in FY25 and FY24 to early FY25. As we move on in 2023, we remain committed to continue our growth trajectory while taking cognizance of the volatility and challenges in the market environment. We will continue focusing on expanding our product offerings and enhancing the distribution network which will lead Kraft to the next leg of growth and create long-term value for our stakeholders. Now I will discuss Q4 performance. The consolidated revenues for the quarter stood at 278 crores versus 261 crores in Q4 FY22, registering a growth of 6.4% on a year-on-year basis, driven by 12% increase in volumes and a 6% drop in prices. EBITDA for Q4 FY24 stood at 5.9 crores versus 15.5 crores in Q4 FY22. Profit after tax for the quarter stood at a negative 6 crores versus 8.6 crores corresponding quarter. Moving to FY23 performance. The consolidated revenues for FY23 stood at 1,284 crores versus 1,136 crores in FY22, registering a growth of 13% on year-on-year basis, driven by 10% increase in volumes and 3% increase in prices. EBITDA stood at 99 crores versus 94.8 crores in FY22. EBITDA margin reported was 7.7% as compared to 8.3% in the corresponding period. FY23 profit after tax stood at 35.8 crores versus 26.2 crores in FY22. PAT margins for the FY23 stood at 2.8%. Now I would request the moderator to open the floor for question and answers. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Devansh Negotia with SAMPL. Please go ahead. Devansh, your line is unmuted. You could please ask your question.
Am I audible? Hello?
Yeah. We can hear you.
Yeah. So in case of other expenses, if you look at our long-term average is around 12-13%, and this quarter has been around 17%. So which line item in our P&L has been significantly higher than what we normally guide.
Yeah, Balaji.
Yeah. So Devansh, if you see, our expenses are primarily fixed. So if we Q on Q3 versus Q4, there is close to 2 crores of increase, which was entirely on account of the business promotion spends that we had in Q4. Other than that, most of our expenses are fixed. Given that the pressure on demand meant that the actual sales numbers for Q4 was much smaller than Q3, and that is why you are getting the expenses as a proportion to sales is much wider than what it is. So it's not that the spends have actually increased significantly between a Q3 and Q4, but rather that the quarter in terms of sales is much smaller.
But if I compare it, last year was 12.5% in March 22 quarter only, and this quarter is 17% as a percentage of sales. And I think half are fixed and half are variable. So the variable expenses should have come down because QOQ sales are down at least I think 15%. But our other expenses are actually up 4 crores, at least 10%. So that variable part should actually drop, I think. But it has actually trended upwards. So I mean, I'm not sure if
you look at our overall expenses profile in terms of what is variable versus fixed, I don't think we have 50-50 in terms of variable versus fixed. To an extent, the marketing expenses are variable, but that is more in terms of the planned revenues that we target. Because when you get into the third quarter and fourth quarter, some of these spends are largely committed, with the agencies and partners that we work with. Freight is one expenditure which is variable, and it has remained, variable per se. And to an extent, the sales commissions that we have would be variable. Otherwise, most of the other expenses are primarily fixed and not necessarily directly correlated to sales. Between last year and this year, I think we had explained last Q4 of FY22 was also affected, with the COVID per se. So we were sort of smaller in terms of our expenses base itself. So to give you a view between FY22 and FY23, we have spent an additional 5 crores on marketing. Our travel expenses is more by about 1.2, 1.3 crores. Freight is additional by about 2.5, 3 crores. And the sales commission per se is more by about 1 crore. But if you ask me, the actual fixed cost base for us is close to what you've been seeing in Q3 and Q4 is more realistically close to our current base in terms of operations.
Okay, so our ad expenses were 33 crores in March 23, 34 crores.
Sorry,
ad expenses.
Full year?
Yeah, for March, for FY23.
Yes, it's about 34 crores.
Okay, and can you help us with the amount of provision for doubtful debts and provision for warranty?
So provision for doubtful debts for the full year, we have taken at about 4.25 crores.
Okay. Provision for warranty?
So warranty includes significant portion of what you see as provision for warranty is our actual warranty spend in terms of the service calls that we get into. Last year it was about 6.7 crores. This year it's about 9.6 crores for the full year.
Okay. And case of guidance for CAPEX, why is it trended upward? We used to guide for 60-70 crores, but we have spent almost, I think, 95 crores. So, what has led to this actual CAPEX being higher than the guidance?
CAPEX is at 75 crores. The additional 20 crores is actually a cash outflow. That is an advance for the future year. That is this current year. Those monies have been given as advance. The actual spent is the 75 crores for the CAPEX list.
Okay. And why are debtor days have actually increased 15-20 days this year? So is it mainly in general trade? Because I think e-commerce is 30 days. So how the data are shaping up? Can you just throw some light?
So most of our channels we have moved to channel financing, but particularly the e-com companies are still on the credit days. We are working on that, and our revenues from Flipkart in the last quarter is what is impacting the receivable. So it is longer than 30 days for with Flipkart, but we are also working on having a discounting platform for these sales.
Okay. So and how was the mix, channel mix, FY23 versus FY22?
1 second. I'll give you that. You want to do that? For us, the general trade is 42% because we grew substantially in the general trade last year. Modern retail is 10% now. E-commerce is come down to 30%. We have corporate sales at 5% and exports at 10%.
Okay. And how are you looking
sorry to interrupt you there. Due to fairness to others, could you please join back the queue?
Sure. Thank you.
Thank you. Ladies and gentlemen, a request. Please restrict yourselves to 2 questions per participant. We move on to our next question from the line of Lokesh Maru with Nippon India Mutual Fund. Please go ahead.
Thank you. So my question is more around absorption of fixed costs. So given that we are in a growth phase, we are expanding our capacities and distribution reach, everything. For last 2 years, we have not been able to absorb the kind of fixed costs that we are incurring, right? So any changing strategy, even for last quarter or last year, if our top line would be 1,400 crores or so, we would have been able to absorb those costs and deliver the commitment of %.
Yeah, we are very close to that. Ideally, we should have got that this year. I can say the third quarter and the fourth quarter revenues were not as planned as budgeted. Otherwise, we would have already got there. There is a little shortfall in the planned revenue, and with the strategies that we now have and the plans that we have set up and the new pipeline of products that we are launching, we believe that in the current year we'll be able to reach that threshold number where we can cover all the fixed costs.
Okay, so again, given that Q1 is again going to be seasonally weaker, so to start with, how has the demand momentum been for the month of April and May?
Demand is tepid. It's not that it is very strong, but again, I want to repeat, we have a strong network, distribution network, our brand is playing. We are able to grow over the previous year's quarters, but it is not as desired. The desired in the normal desired demand scenario, we'll be able to grow much higher. Our CAGR for the last 5 years is at 19%, while last year we grew at 13%. So if there would be normalized demand, we would be on the higher double digits, but it's a lower double digits.
So, given during this tepid demand environment, again, sequentially covering up or absorbing the fixed cost will be difficult. So, are we trying to absorb the same via expanding our gross margins, or does our gross margins stay put where they are? Or how do we plan to absorb these costs?
Margins by about 0.8%, and we believe that we will be able to improve our gross margins even in the current year by not less than 1%. While our focus is also to improve on the gross margins, we are also cognizant of the factor on cost considering the current scenario. So I think both these will enable us to get back to our aspired EBITDA margins, maybe by the end of the first half.
Okay, sir. Understood. Thank you.
Thank you. Our next question comes from the line of Pritesh Chheda with Lucky Investment Managers. Please go ahead.
Sir, we are a large market share by volume terms in many categories, and we have expanded or put up a large capex in the last 3 years. Now, last 3 years combined is something like 270 to 80 crore of capex that we have put, which has corresponding added on the manufacturing overheads. What is the way that you're going to balance the margin assumption or margin expectation and the growth expectation from here on? Because what we have seen in the last 2 years is that the growth and the capex is unable to just absorb the cost that you have added, and we are a large market shareholder any case by volume terms. So any thoughts on the strategy this side, sir?
So all the three, while we will want to continue to grow, there is absolutely no looking back at the growth. We are on a vision to be leaders in the category. Having said that, we are also cognizant on the margin front. These are, I can say, favorable times. The material cost is also quite stable now with this and with the price hikes that we are taking, reasonable price hikes. So we believe that our gross margins will also go up now. Particularly, I can say that you can see significant growth on our gross margins before the end of the first half. And as our revenue grows, the leverage will definitely help us to get to the aspired margin level, the EBITDA level.
Have you revisited your capex now? Or
yeah. So the planned capex for this year, we believe what we would ideally want to do is we would want to not actually let go that, we'll defer it. So I can say the capex that was planned for this year will be doing between this year and the next year.
So what is that capex number, sir?
We would guide you that we would want to not spend more than 25% of our PAT along with the EBITDA along with the depreciation put together. The sum of the depreciation and 25% of our PAT is what we would not want to exceed on the capex going forward.
Sir, I still couldn't understand your. I understand that if you grow your top line, then the margins come. But what has happened in the last 2 years that the cost increases because of the capexes have been high. And you're saying now you will take price increase. But when you go, so are you now willing to flex your muscle a bit on the brand and the market share volume that you have?
I can say still there is enough room for growth on the market share. we will continue to focus on our market share. That does not deter us from being confident about our position in the market.
Sir, what we have learned is that when you have a 30% market share by volume, every incremental market share gain is a little bit costly affair. So, would you try to balance the margin and growth?
Yes, definitely. Without compromising on the growth, we are confident of increasing on our gross margins.
And by virtue of price hike?
Obviously, the gross margin, I am telling you at the initial, is not about after the various costs. It is at the point of realization to the company. So the gross margins is where we will definitely focus to increase. We are very confident that from 31.8% last year, we are confident that by the end of this first half, we should be at least 2% above that.
So then when we listen...
Sorry to interrupt you there.
It's just a follow-up. Let me finish it. So then next time in the second half or, as your strategy, instead of a band of gross margin that you were always giving, which was, I think, 31 to 35, if I'm not wrong, 33 to 35, that number.
Definitely midway.
That band will change on the higher side.
So I can suggest you, what I can assure you is with the working that we currently have, we believe that we'll definitely reach the 50% price band. So 31 to 35 will be not less than 33.5 is what I would say.
So as a longer term strategy, that band will change, right? Because if you are
keep moving up, as you see, when you get economies of scale, even in manufacturing, there is an advantage that you get. And obviously that leads to lower costs. It does not mean that we lower our realization to that extent. And also the backward integration is also helping us to increase our margin because with lower costs. Both these, while not all of it is retained, but majority of this is retained. We are competitive enough now.
But sir, you mentioned that you're postponing your capex, right? So in a situation where what assets you have put on ground and you have to work with that, price increases is the way to improve that band, gross margin band, right?
Yeah. So I will tell you on the capex, there are two large capex this year. We have a requirement for a larger warehouse that is a work in progress. There is another large scale cookware that being while we could have already in another circumstance we had done very well in the FY23. We would have used that money to invest on this catering line. While all that orders are placed, we will only defer it a little to the last quarter of the first quarter of next year.
Okay, shall we come back with some clarification? I'm a little bit confused on the whole concept, but I'll come back in the queue.
Thank you. Ladies and gentlemen, a reminder, if you wish, please restrict yourself to 2 questions per participant. Our next question comes from the line of Khush Gosrani with InCred Asset Management. Please go ahead.
Yeah, hi sir. Sir, I wanted to understand, is there, since we have a high revenue coming from e-com, is there any inventory provision that we have made this year? And what would be that amount?
So it's not very high, but in normal course, as a concept, ETL material availability, where any material beyond the threshold period, we have it in our warehouse, we provide for this. So both for the ETL policy and this, we have already provided. In the material, I can say we have provided for about 7 ETL. Around 1.2 crores is for ETL and for data.
Okay, sure, sir. And sir, we have, we are increasing our advertisement spends given despite, there has been a weak demand environment. So do you feel that the costs are justifying the spends because the sales growth is not flowing through as of now?
Yeah, I will highlight that.
Sir, your line is breaking. Hello.
Oh, ladies and gentlemen, the line of the management has disconnected. Please stay online while I reconnect. Ladies and gentlemen, we have the management connected. Kush, if you could please go ahead and re-ask your question.
Yeah, sure. Sir, I wanted to understand, given that the demand environment is still very weak and across the industry players, doing higher advertisement spends right now justifying the cost?
So our advertisement spend not more than 3.5%. We continue to be in that range, therefore a decimal point in there. And we believe that being a consumer brand, we need to invest on our, maybe these are temporary times when there are weak demand, but the demand is definitely going to come back. We are in a product category which is actually consumable in nature, though it is consumer durable. We are very confident about the demand. And also we keep introducing new products in the market, which also require a reasonable communication to our consumers. And we believe that we should continue to invest this 3.5% at the lower end on marketing spend.
Okay, sure. So, and sir, what capacity utilization we would be sitting on?
So it is, our business itself has, for every quarter is different. The first and the last quarters are little lower, smaller quarters, and second and the third quarters are larger. We peak out during the second quarter. Maybe the third quarter is very close to the peak. But the first and the last quarter, there is enough spare, relatively spare capacity available. But since it is seasonal, we cannot have 100% utilization of our capacity. But it's not that during the peak we have too much of spare capacity. That's where we are.
Sure, sir. And sir, you just highlighted that gross margins will improve from here. So how will it flow to EBITDA margins as well? Because you are guiding for a double-digit EBITDA margin, but the cost does not seem to get absorbed, and gross margins also not improving too much.
So the increase in our top line directly flows to EBITDA. These are kind of fixed costs currently whatever is the cost level we have, but for a small increase, we believe that we will be at the same level, and even 10% increase on our top lines can give us closer to 3% improvement on our EBITDA.
Okay. Sure, sir. Sure. And if you could, just last question, highlight category or product-wise volume growth, which you used to give till last year, which you have not given this year. So if you could, and own versus trading.
I think I can again repeat. It was in the percentage on the pressure cooker, we have grown by 19.6%. In the non-stick cookware, we have grown by 16.8%. In the induction cooktop segment, we have grown by 13.4%. The gas cooktop segment, we have grown only by 4.3%. And the small appliances, overall, we have grown by 11.1%.
And sir, LED?
LED is a very, we did a lot of channel correction in the last quarter, so we have grown for the year at 2.1%.
And sir, what would be the manufacturing, in-house manufacturing versus traded mix?
We are in the same range of 90%. 90% is manufactured, and closer to 10% is what we trade.
Okay, sure, sir. I'll get back in. Thank you.
Thank you. Our next question comes from the line of Harshal Sethia with AUM Fund Advisors. Please go ahead.
Hi, sir. So with the current gross block that we have, what kind of turnover can we do at peak utilization?
Yeah, we are ready for a 2,000 crore revenue.
But sir, I guess the 2,000 crore revenue which you said, you also used to say that almost 2 years earlier also with the current capacity that you had, and at that time the gross block was around 220 odd crores.
So there are two investments that we have been doing. Of course, we have added some lines to manufacture those products that we either were importing, and also a lot of it has gone into our backward integration to also mitigate the challenges of the supply chain, particularly for the import, components that we are importing. So it may not necessarily only increase in the revenue. It is also to ensure that we do not have a disruption in our manufacturing. But both, I can say there are some lines that we have added which have moved from trading to manufacturing. So in the last 3 years, if you will have seen, what used to be a 70% contribution to manufacturing has moved to a 90%.
Okay. Sir, one more thing. You said that we have invested in backward integration in the last 2 years, but our gross margins have remained the same in spite of such kind of backward integration.
Yes, you are right. In the particular period during COVID, we had a real low cost. It is not in line with what generally the costs are, and in that year we definitely had a higher gross margin. But it also is because of our backward integration, which is helping us to be more competitive in the market, and that's why we are able to get back to that gross margin what was there during the COVID.
Okay. So secondly, my thing is, like you said that at peak utilization we can do around 2,000 crores of top line. At currently with around 1,250 crores of top line that we did in the last year, we are almost at 60% utilization, and we are hardly doing break-even levels in terms of EBITDA. So
we doing break-even.
Yes, because last quarter we almost did 2% EBITDA margin.
So last quarter is an exception. Please don't evaluate based on only the last quarter. Last quarter was a challenging quarter. I can say the industry itself has witnessed a very weak demand. I can say that the company are able to grow in this challenging time. And the first and the last quarter do not really reflect the true revenues of the company. 60% of the revenues are coming from the second and the fourth quarter.
Okay, but even though for break-even levels also, what I'm trying to understand, just by annualizing the full years of last quarter full year revenues also, which is at around mota-moti 1,100 crores, that is at 55% utilization, not 60%. So it's not a major change in terms of utilization levels, where we are just doing break-even kind of margins.
At a peak, we can also go to 600 crores, not even 500. with the capacities that we have, there are two things. One is the business that is planned for a revenue, and sometimes what you deliver. Of course, today there are particularly the last quarter, there was a mismatch between the expected revenue number and actually what we delivered. But the capacities that we currently have, we can actually stretch it to 600 crores if I say at full.
Okay. So secondly, not going into the margins to be per se, you said that overall the whole demand environment was tepid and we almost grew at a higher double-digit number. What I want to understand is going ahead with almost like 30% market share, and being a brand like Pigeon in having pan-India presence, why aren't we able to pass on the price hike in terms of raw material?
We did not have any challenges on passing on the price, or there was actually, I can say that there was no price hike during the particular last quarter. It is not linked to the passing on the price or the input cost. It is more to do with the market scenario, the demand per se. And if there would have been a price hike in the input cost, obviously we would also have passed on those price increase to the market. It is not a scene where we are not able to pass on the input cost hike. It is a different scenario. It is a scenario where the market demand or the sentiment is a little weaker.
I'm talking about the full year, sir. You said that overall volume growth for the was around.
If you could please join back the queue for follow-up questions. Thank you. Our next question comes from the line of Achal Lohade with JM Financial. Please go ahead.
Yeah, good evening, sir. Thank you for the opportunity. Just taking forward the earlier participant's question. With respect to, you said, basically the March quarter was very weak. We couldn't absorb the cost and hence the margin impact. Now, what I'm trying to understand from you is that where the mismatch was, was it really sudden? Was it gradually the weakness was setting in? And, if it was to repeat, how do we deal with that now?
Okay, to give you some numbers, that if we had done a revenue of 350 crores, we would have definitely had another, say, 22 crores of flowing to our EBITDA. And then this whole stack of numbers would totally look different. And in a normal situation, like you already know, that we are going upwards in spite of this, if we even provide for the slow growth in the last quarter. The last 5 years, we have grown at 19%. And we believe the companies, the way the system is built, the team, the capacity, the brand, the dynamics of our distribution network, all these are built for that kind of growth. Of course, that certain cost. So I to simply answer you, if we had even been closer to our planned number, we would be in the range of the EBITDA that we expected. For us, any incremental over the break even if we do a 10 crore number, at least not less than 2.5 to 3 crores flow to EBITDA.
Fair. No, where I was coming from is that, you said basically the margins got impacted because the 3Q and 4Q were lower than our expectations. Our costs were budgeted with certain revenues in our mind. Now, what I'm trying to understand is where the negative surprise was from. Was it from particular category, particular geography? Was it overall sluggishness? How do we appreciate that? And
Okay. So to tell you the fact of the matter is we have grown in all channels and all products, but for the e-commerce channel, and I can say that the numbers did not stack because we did not grow on the e-commerce channel, and it is last time. But I also want to assure you that we are seeing growth again in the e-commerce channel now. For the last year, we were either flat or I can say we degrew by about 2% of the e-commerce. That revenue difference of what the company grew at, if we had also continued to grow on the e-commerce, our overall growth at the company level would have been in the range of 17-18%. The difference of about 150 crores would have straight away flown to, 30% of this would have more or less flown to our bottom line, EBITDA number.
Okay, so if I understand you correctly, it is the e-com where the negative surprise was, and that is what corrected. Have I understood?
Yes. You are perfect. Actually, we have grown well on the general trade. We have done very well on the modern trade. Our exports have also done well. We have grown by 38% in export, about 14% on modern trade, and 17.1% on general trade. We have exactly degrew by 1.9% on e-commerce. We are very positive over the e-commerce channel, but there are multiple reasons over the different quarters that we had in e-commerce. There are also, I think, the consumer behavior also was a factor that they were shopping offline, apart from the operational challenges in the beginning of the year that we had in e-commerce. But all that is a past. I can say that we are seeing again good growth on e-commerce.
When you say good growth, is it double digit? Can we assume that?
Yeah, we believe that any growth upwards of in the double digit is only good growth. Ideally, we should be on the higher double digit, but we are seeing good growth. At this point of time, I can say that we are seeing good growth.
Right. And you also mentioned that April and May, just a clarification, this is an extension. Let me just finish, please. This April and May was weak, so given that context, what is the revenue growth and margin guidance we wish to have for FY24 as a whole? And B, if there was again a surprise on whatever reasons in terms of revenue growth, how do we ensure that we still touch the double digit magical?
So I can say that we for the AOP of this year, we have capped our expenditure very close to what we have incurred in the last year. And we are very confident of delivering a growth. Even, of course, as you rightly have analyzed in the status, there is a slowdown kind of a situation currently, but we are still growing. It's not that we are not growing. And we believe that with the onset of the festival season, the growth, the demand is going to be back. And with all that, if we normalize, historically, we have grown at about 19%, and even under the challenging period of last year, we have grown at 13%. So I think we would be anywhere between this, and in a good time, it could also exceed that.
Got it. I'll come back in the queue, sir. Thank you so much.
Thank you. Our next question is from the line of Anand Mundra with Soar Wealth. Please go ahead.
Yeah, hi. Good evening, sir. Sir, what is our guidance for CapEx for FY24 and 25 since we have split the amount?
So ideally, Mundraji, we would want to spend not more than 25% of our PAT on CapEx, along with adding up the depreciation that we have for the particular year. So it depends on how the year transpires. We already have a CapEx plan, but we would want to defer it to the last quarter and between the last and first quarter of next year. So that is the plan now.
Because, sir, earlier we were thinking of 60-70 crores. In absolute amount, since you have deferred it, can we assume that you are doing 30 crore capex for FY24?
No. So to still say, an ideal situation would have been capex of about 55-60 crores. But there is some capex is ongoing and some which is already paid off. And the advances have been paid off. I'm telling you, a major portion of our capex for this year is to set up this foundry for our cast iron cookware, which is already planned. But we would want to take this investment in the first quarter of next year.
Okay. And sir, since you have taken a prudent decision on delaying the capex given the slowdown, is there any way you can rethink about your retail store expansion plan also? Can we delay that also because there is no growth and it's increasing the expenses below EBITDA also?
No. So I want to again guide you on this. We are committed to expand our retail, but we have formed a new strategy where we are also onboarding franchisees, which will substantially bring our cash outflow to expand the stores down. The model is already in place, and we are also seeing good interest. So as the year progresses, you'll see a lot of these stores from existing stores and the new stores being company owned but franchisee operated, which will free up the cash investment into these stores.
Okay. So, sir, can we assume that we will not be doing any funding of any retail stores from our balance sheet then for this financial year, or there can be some mix?
See, at the rate that we would want to build these stores, it is closer to 100 stores for this year, and in normalized capex will be in the range of 15 to 18 lakhs. But I would say it will not be zero. It could be very, very substantially lower than otherwise what it would be. It will not be zero.
Sorry, can you give us guidance in terms of number of stores, say 100 stores, how much we will be funding from our own balance sheet?
7 to 8 stores per month is what we would want to do. Or that is the run rate we are now moving.
No, that I understood, sir. So I'm saying out of the 7, 8, how much would be franchisee owned?
In all these 100 stores, we believe will be funded by the franchisees. It's not limited to the new stores alone. So there could be the stores that are already performing well, and we would also move these to franchisees.
Okay, thanks, sir. Sir, one more thing on gross margin, as Pritesh was asking you, what is our guidance on gross margin for FY24? So since we have done 31.8%.
On the gross margins, we already improved about 0.8% compared to the previous year to this year. We believe that we will be able to get to, in a normalized situation, unless there is any volatility on the input cost, we would be in the range of 33.5.
So it would be minimum 33%, sir?
This is the operator. If you can please join by the queue for follow-up questions.
Okay, thanks. I'm done. Thanks a lot. Sir, one last statement I wanted to make. So below EBITDA also there are a lot of costs now. Depreciation is very high. Interest cost has gone up because of retail lease expenses. So would request you to also increase the PAT. We need to have minimum for 20% ROE, we need to have 11% EBITDA. Otherwise, the PAT goes into single digit, very low single digit. Anyway, thanks a lot, sir.
I'll tell you something that we are cognizant of this EBITDA number, and but for this, of course, we are discussing during a time when we have underperformed in the quarter, but the company's cumulative strength to deliver the 11% EBITDA is very much intact.
Thank you. Ladies and gentlemen, in the interest of time and fairness to others, please restrict yourself to 2 questions per participant. Our next question comes from the line of Paras Bodra with Ashika India Alpha Fund. Please go ahead.
Good evening, and thank you for the opportunity. So this is with regard to what you said, that there has been a slowdown. So I wanted to understand what is it that is leading to the slowdown for the industry per se and for you as well, and more particularly on the e-commerce side, when you say that this has been a real drag for us. So what is happening in the e-commerce space? Is it that the competitors are taking your place, or what is it that is driving, if it is an industry-wide phenomena as far as e-commerce is concerned, and why you are so confident that next season things will pick up? So this is one question.
Well, let me guide you to one thing, that we continue to lead in both the e-commerce platforms. The platform itself have witnessed a change in the base that was set during the COVID times. Probably the base was high. And the way they were doing business, there were large sellers on the platform which have moved out and the new ones are coming. So there was an operational issue in the beginning of the year that is also set aside. And the consumer behavior also was, had impacted to a certain extent. But I can tell you that in the recent times, we have seen that the e-commerce channels are also performing to earlier levels, or growing at the earlier levels. So we believe that e-commerce business is again on the same trajectory of growth that we were witnessing in the earlier years.
Okay.
On the growth, on the demand side, I can tell you that For particularly during the festival season, there is always a good demand for the kind of products that we have. Starting the second quarter, all these festival seasons are kicking in, starting from the south. So we believe the growth will be back to normal.
Okay, got your point. Second is with regard to other expense. So when you say that you will cap your expense to what it was last year, say for FY23, so how do we look at it? Is it going to be as a percentage of sales that it will be capped? And what has been the reason or the components of it that the expenses have gone up, other expenses by 22%, whereas the top line was at 13%?
You're right. So if you see the number, we are closer to 310 crores of complete. So if you'll see, for us, expense, it also includes the manpower cost. So we are at about 310 crores of expense in the previous year, and we have added enough people to cater to all the demand that we envisaged. So more or less it is there. But for say 10-15 crores additional spend for this year, this is not going to exceed that number. That is a combined spend on both on the manpower and other expenses.
Okay, fine. So the last question from my side, and this is a basic question I wanted to just have a clarification on, is with regard to the Pigeon brand. Is it with Kraft or how is it? Rest with Kraft, right?
Time it was registered, it has remained with Kraft.
Okay, perfect. So that's all from my side. Thank you so much.
Thank you.
Thank you. Our next question comes from Rasmik Oza with 9 Rays Equity Research. Please go ahead.
Yeah, thanks for the opportunity. So our strategy has been, that we are backward integrated and manufacturing has been a forte, and we sell on markup and very competitive in terms of pricing. So I just want to understand, as compared to FY23, what kind of price realization increase we are looking at in FY24, a little leg up to the EBITDA margin.
So I can say that we are working towards increasing our gross margin by not less than 1% over the base of last year.
Okay. So because in the morning in one of the TV channels, you had given some guidance of 11% EBITDA margin, and we are at 7 point. We are.
I feel that the company has all the capability and they're strong enough to deliver the 11%. We believe in with what all that we have already put in, all the efforts to build the strong team, the manufacturing facility, and the brand strength. We are confident that by the end of this first half, we should be able to be back there.
Okay. So is it fair to assume that, we have 7.7% EBITDA margin in FY23, and if you go to 11, you need to increase the 330 bips, out of which 100 bips will come from gross margin and around 230 bips will come from maybe, because of static fixed cost, something like that?
Yeah, more or less that should be the correct understanding.
Okay. And sir, you have some targets of, in taking exports to around 20% of revenue next 2 to 3 years. So just wanted to understand the path. If this exports go from 10 to 20% in the next 2 to 3 years, does it impact the EBITDA margin positively or negatively, or indirectly? Are the margins in the exports better off or better than the domestic business?
No, at the EBITDA, both domestic and export margins are neutral. At the gross margins, the export margins are lower. We have grown last year at 38%. We believe that, of course, last year was also good, but we still continue to see good demand from our export markets. But to answer your question, at EBITDA margins, it's neutral. Maybe 0.51% this way or that way. But at EBITDA margins, both the businesses are at par.
So last question, sir, for FY24 to 25-26, any guidance you're trying to give on the ROE or the ROC? What kind of internal benchmark you have for return ratios for the next 2 to 3 years?
We will get back to our ROC that in the past we were closer to 18-20%. So we'll get back to the 20%. This is what I can assure you at this point of time.
Okay. Thank you, sir, and best of luck.
Thank you.
Thank you. Our next question comes from Arichit Malakar with Ashika Stock Broking Limited. Please go ahead.
Thank you for the opportunity. Yeah, my question is, sir, what gives you the confidence that demand scenario will improve and we will be able to clock high-teen growth in FY24? And my second question is, what strategies actually we are taking to improve the margins going ahead?
On the margin front, we have already taken, all our margins are linked to cost. We have consciously ensured that we achieve at least say 33.5% gross margin, and we have delivered about 32.5%, 32.8% gross margin last year. So we are confident of the increase in the gross margin. That's the second question. You are asking for the gross margins and about the demand scenario.
And the demand scenario, what gives you the confidence and the demand scenario will improve?
It's not that always the markets are sluggish, and the category that we operate are actually having high replenishment, we are actually addressing a CG, which is, particularly in our country, a lot of them are moving to the affordable segment, and we are the first brand of choice for them. This growth that we have witnessed in the last year, about 13% of growth, is under very, very challenging circumstances. It's not that every time the markets are going to remain same. In a normal situation, normal scenario, our growth rate, as I again want to reiterate, that we have been growing historically the last 5 years at a CAGR of 19%. So we believe that we are actually the business that we have built and the company that, with all those capabilities that I have, it can easily deliver that historic growth rate in a normal situation. And the 13% was delivered under very, very, I can say, weak demand scenario.
Okay, thank you, sir. Got it, sir. That's all from my end.
Thank you.
Thank you. Our next question comes from the line of Khush Gosrani with Incred Asset Management. Please go ahead.
Yeah, hi. Thank you for the follow-up. Sir, I wanted to understand what would be the channel-wise gross margins, because as you highlighted, there was a negative surprise for e-com, and hence it has led to lower sales and lower margins. So if you could just highlight what are the margins in channel-wise trade, how it has moved across.
I would want to assure you that other than the export business, all the pigeon brands, whether it is channel or product or margin agnostic, I can tell you the margins are the same, whether it is with our channel that we operate or with our product. At the mean number, they are all the same for us. At the point of realization, net of all the schemes or discounts that we provide to these various channels, the net realization, most of all are at the same number.
Okay. And sir, as you have highlighted, 54 retail stores were open. So if you could highlight what kind of revenues they have generated and what kind of profitability level they are at right now.
The gross margins for these stores are in the range of 45 to 48%, and our cost to run any store is in the range of 1.25 to 3 lakhs. And on an average, these stores are delivering upwards of 4 lakhs a month. So I can say that while the number of 54 this month, current month, I'll just guide you to, we are able to get to a 2.5 crore revenue. It's not 54. This 54 number was the end of the quarter. Subsequently, we added stores. We are at the rate of adding 7-8 stores a month. I'll tell you the other advantage with our stores. 69% of their customers that have visited the pigeon stores are first-time buyers of pigeon stores. These are absolutely new to the brand. Then we are also experienced that wherever our pigeon stores are there, in the regions where the pigeon stores are there, our GT is started performing better than in the past.
Okay. No, I agree with the strategy. I just wanted to understand because
we at the corporate level also we are now making profits on our retail, but store level even at 4 lakhs we make good profit.
So in how much time do these stores get profitable? Because initially they would be impacting the margin.
After the first 2 months of operation, Then all the stores that we have so far opened, they have been profitable after the third month.
Okay. Got it, sir. Got it. Thank you, sir. Thank you.
Thank you. Our next question comes from Akash Jain with Money Curves. Please go ahead.
Yeah. Thank you, sir. I think the message from all investors in this call has been quite consistent, right? In the sense that the market is stated. Beyond the point, we have limited control over how demand will play out. And our structure, given the fact that it's very high fixed in nature, we will always struggle on margins and on ROE in an environment where demand is not very strong. And I think over the last 2 years, unfortunately, the timing of additional cost and capex has been such that we have run into a lower demand scenario in a time when we have actually put on a lot of cost and capex, unfortunately, from a timing perspective. So the only thing I want to say, sir, is that a market, even if you don't grow too much as compared to your competitors, but you are able to protect margins to some extent, I think that probably will play out better for us as investors. And in categories where our market share is already quite high, pressure cookers, etc., I don't see any reason why we should be at 25% discount to the market leader. And I think at a category-wise level, some price hike is warranted. As an investor and as someone who uses chicken product, I can tell you that the product is very good. I don't see any reason why it should be a 25% discount to the market leader. In categories where we are not going to clock too much of additional market share, I don't see any reason why we should not take the chance of trying to increase pricing and see what happens. Because even if we are not growing at 7% or 6%, but growing at 2%, but we are able to protect our margins better, my sense is that we play out much better. So my only request to you is, in a typical demand scenario, it is not necessarily that we try and increase revenue too much, because it's anyway not going to happen, because the headwind is there on demand. So let us also look at margins, because if whatever scenario, if we grow a little bit, but it comes at the cost of ROE and margins, it's probably not something that investors and shareholders appreciate a lot. So I think that's the limited feedback. I think that feedback is probably consistent from all investors. I thought that I'll just say my point to you, because margin is very important. So if you don't have margins and ROE, a 7-10% growth does not really help too much, because we have to protect margins and ROE.
First of all, thank you for the evaluation and observation of the quality. Point fully taken in whatever you suggested.
Thank you, sir.
Thank you. Our next question comes from Harshal Sethia with AUM Fund Advisors. Please go ahead.
Hello.
Yes, sir.
Yes, sir. So one more last question. So what kind of price hikes are we taking in the first quarter to reach gross margins of 33.5%?
So to say, I tell you, while there have been a higher price increase, we also in the beginning of the year been offered some schemes to our general trade. So particularly in the GT, it's not that we recover all the price hikes that we take. I can say that we have taken good price hikes in this current year. With the way that we believe that we are very confident of increasing our gross margin at least to a level of 33.5%.
Okay.
Thank you. Ladies and gentlemen, in the interest of time, that was the last question. I would now like to hand the conference over to Mr. Rajendra Gandhi for closing comments.
First of all, I would like to thank each one of you for having the interest and confidence in the company and having spent your time to understand about the company. Under challenging circumstances, the company could deliver good growth. Of course, we have let down on the EBITDA and PAT numbers. But we would want to assure all our analysts here and the investor fraternity on the whole that the company is on a very strong footing of high growth, and will be able to deliver the aspired EBITDA and the margin numbers in the coming quarters. Thank you for the patience today.
Thank you. On behalf of Kraft Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.